This is a story about corporate collapse and one of the largest frauds in modern business history. At its peak, Enron was considered a major energy company. It was praised for innovation and growth. Investors trusted it. Employees believed in it. But behind the public image was a different reality. Enron was hiding losses, and it was doing so on a massive scale. The core of the fraud was complex accounting. Enron used special purpose entities, or SPEs, to move debt off its balance sheet. This made financial statements appear stronger than they were. The company reported profits that did not exist, and investors did not see the true risks. Executives used these accounting methods to inflate earnings, to maintain stock prices, and to secure more investment. The fraud relied on secrecy. The SPEs were structured in a way that made them difficult to understand. Even some analysts and regulators did not fully grasp the complexity. Enron also used mark-to-market accounting. This allowed the company to report estimated profits based on projected future revenue, even if the revenue never occurred. This created an illusion of growth, a public image of success. Inside the company, pressure increased. Executives pushed employees to meet financial targets, and the targets were not realistic. When the truth began to surface, confidence collapsed. Share prices dropped rapidly. Investors withdrew. Employees lost their savings. In 2001, Enron filed for bankruptcy. It was one of the largest corporate bankruptcies at the time. The collapse had far-reaching consequences. Not only did investors lose money, many employees lost retirement funds, and the trust in corporate accounting was severely damaged. Investigations followed. Executives were charged with fraud and conspiracy. Several were convicted. The case highlighted the dangers of unchecked corporate power and weak oversight. The Enron scandal also led to major regulatory changes. One of the most significant outcomes was the Sarbanes-Oxley Act. It strengthened corporate governance, financial reporting, and audit standards. The case remains a major example of how complex financial structures can be used to hide wrongdoing. Enron demonstrated how corporate culture can influence ethical behavior. When success becomes the only goal, rules and transparency can be ignored. This scandal also showed the risks of trusting numbers without understanding the underlying reality. Enron was not simply a failed business, it was a deliberate fraud. The $74 billion figure represents the estimated market value lost. It is a reminder of how large-scale financial deception can impact society. If you want more serious investigative reports, corporate fraud cases, and financial crime investigations, subscribe to the channel and comment below. What should be the strongest punishment for corporate fraud at this scale?